Assalamu alaikum everyone. Hussain Qazi here, your AFM instructor. The session is about international investment appraisal. AFM, ACCA AFM subject, and the topic is about international investment appraisal. Candidate, this is another important and core area of the examination, and still we are at the part of the advanced investment appraisal. This is the another topic of advanced investment appraisal. The previous topic was adjusted present value, which we have already done. So international investment appraisal, what is that? What is this topic about? But before starting this topic, you have to aware that the exam scope of this particular topic from 25 marks to 50 marks. 25 marks to 50 marks. That is the exam scope. Candidates, what is the topic about? Before starting in detail about the topic, do remember one thing. International investment appraisal, that is NPV, present value method. After completion of the APV topic, you have to realize one thing, that now in the subject of AFM, you have left up an assumption that any of the investment appraisal with the changes of financial risk or without changing of the financial risk, any of the investment appraisal, either domestic or international. Whatever we have done till now, including F9 revision and F9 studies, you haven't studied any topic or any investment appraisal for international basis. You will study first time about the international investment appraisal. But before that, you have to aware or you have to clarify one thing, that any of the investment appraisal, either domestic or international, evaluation by present value method having two possibilities. First possibility is that you have to evaluate that any of the investment resulting or changes the financing structure of the company. If no, then we will use the NPV method, either local or international. If yes, the capital structure changes, either local or international projects, then we will use the APV method. So candidates, here the topic is either the NPV method, foreign investment appraisal can be examined either by NPV method or APV method. Examiner has already examined both of the categories of international investment. Means international investment appraisal by NPV method and international investment appraisal by APV method. But do remember one thing, examiner majority times examines the NPV method for international investment. Only one time examiner has examined the APV method for international investment. That is determined, and you will get the session of the APV method later on. But initially, we will start the topic of the international investment appraisal by NPV method. Later on, we will discuss the APV method. Candidates, do remember one thing, examiner majority times examined this topic with 50 marks. And most of the aspects of the investment appraisal, including calculation, but we cannot ignore the theoretical aspect. By upcoming session, we will also discuss how to handle the theoretical aspect, including the reporting aspect of any particular question. I repeat one thing. If examiner examines the NPV or APV by international investment appraisal, and if it's 50 marks question, almost 25 to 28 marks related to calculation. Rest 20 to 20, 22 to 23 marks or 24 marks, or even so we can say that 20 marks. Examiner examine the theoretical aspect, including report plus some calculation aspects. Sorry, including report theory and some other specific theories we will discuss later. But more focus about for this topic, that international investment appraisal, we will initially discuss the topic by NPV method. Now starting the topic, initially, first of all, we need to understand what is the topic about. In a very simple manner, the topic is about, it's in a very simple manner, evaluate the international investment opportunity. It's simple. Evaluate here means calculate the present value, either by NPV method or APV method. Both are present value method. There is some international investment opportunity and we have to evaluate it. Number two, make up your mind. Let's suppose that you are an Australian based company. Your local currency is in Australian dollars, and you have an investment opportunity in the UK. So visualize this point in your mind. You are an Australian investor, you belongs to Australia, your local currency in Australian dollars, but you have an investment opportunity in the UK and the sterling is your foreign currency. So visualize in this manner that you have to calculate all the cash flows. You have to calculate all the cash flows in foreign currency terms first. First, identify all the relevant cash flows in foreign currency terms, that is UK sterling in this case. And after that, you have to convert your future cash flows of the foreign currency into local currency, that is Australian dollars. But the question is that how to convert the foreign currency cash flows in the local currency cash flows. The answer is very simple. The subject is about the finance management is about estimations. So first you calculate the estimation of future cash flows. Same thing. We have to calculate or estimate the future exchange rates. So we will convert the future cash flows with the estimated exchange rates and convert Australian dollars into convert sterling foreign currency into Australian dollars. I repeat, first of all, evaluate the foreign currency cash flows, that is sterling, then calculate the expected or estimated exchange rates, then convert the foreign currency, here the case sterling, into local currency, here the case Australian dollars, and must have to stick one point. Your final NPV answer should be in your local currency, here the case of Australian dollars. So that is what the introduction of the topic. Now we have to consider what are the relevant workings here. Very initials. An introduction. It's just an introduction. Then we will enter into the workings. Number one, candidates, is very clear. Estimations of the exchange rate, it's must. And you have already studied in your F9 subject. We will review by next few minutes. We can estimate the exchange rate by purchasing power parity theory or interest rate parity theory. Triple PT means purchasing power parity theory or interest rate parity theory? It's very simple. You know very well that any of the if we need two countries exchange differences having the reason number one, inflations. So we will pick the spot rate, for example, Australian dollar over UK sterling, and then for example 4 years project. So 4-year expected inflations of UK, take out the 4-year expected inflation of UK as well as Australian dollars or Australian company. Sorry, Australia. So UK's current spot rate will be estimated in future on the basis of two countries' inflations. If inflation is not given, then we can use IRPT, that is interest rate parity theory. How it will work, we will discuss just in a couple of minutes. Number two, very basic working, very basic working. Estimate the future cash flows in foreign currency. Here the term FC means foreign currency. For example, here the case, estimate the sterling cash flows in sterling, and then based on number one, estimated exchange rate, convert into the local currency. But here are some complications. And time by time we will discuss. Just intro about the complications. Connect to my example. For example, you are Australian based company and you are opening a hotel chain in UK. Let's suppose hotel chain in UK. So some of the cost directly incurred in the UK sterling. That means if you operate in the UK, you will directly purchase some material labor overheads from the UK. Okay, that's sterling. But it may possible that parent means Australian company incurs or supports some material and services to the UK company. So this is the complications. Whenever we will work out on the basis of foreign currency cash flow. So we will means sterling. We will have to incur local sterling cash flows, that is in UK based cash flows, including the cost incurred or arises from the parent. Do remember one thing, we are not here to discuss about anything consolidation. This is not accounting. This is actual cash flows. If the cash flows in UK occurred in Australian dollars, we have to convert Australian dollars into UK sterling. That's one point. And afterwards, once all the UK based cash flows, including the parent company material and services, convert into the local currency sterling, then we will add on more inflows of our local currency, that is Australian dollars, including the material we export or services we export to the investment company. That is our inflow here. That is our income. So this is the complication number one. We will discuss later on. Number two, tax implications. In extend to my example, if there is a tax rate related to UK for our business, that is 35%. So whenever we calculate the foreign currency, we have to pay the tax as well. We have to show the outflow of the tax. On the other end, whenever we come back to our country, that's very much important that there is a bilateral tax treaty. Bilateral tax treaty means there are tax exemptions, and this is diplomatically settled between the government. Let's say UK rate of tax 35% and um, Australia tax rate is 40%. So when I come back to my own country, to the Australia, there is a tax treaty that I have already paid 35% in the UK taxable income. So that 35% exempted in Australia, and we will additionally pay the 5% only. So that is called tax treaty. But do remember one thing, tax will be paid on taxable income, not the net cash flow. Tax is paid on the taxable income. We will discuss this point later on. So this is tax treaty. I know that there is a question in your mind that, there may be the question in your mind that, sir, what if there is example that in our local country the tax rate is higher, that is 40%. In UK that is 35%. What if in UK 40% and in our local country less than 40%, for example 38%? Then do nothing. You have to do nothing. Do nothing. Whatever you have paid tax 40% in UK, foreign, here the tax rate is lower. That means nullify, zero. And the last thing is the remittance. Remittance means whatever the net cash flow remitted from UK to the Australia. So that is the remittance. Sometimes there is a blockage in the remittance. So government restricts some remittance blockage, but we will discuss, that's the theoretical part. So these are the complications, and one by one we will discuss with respect to the questions. Now start some questions accordingly. You can refer the document that I have already shared with you. You have to read the question accordingly with the document. That's a point. Candidates, this is some basic aspect about the international investment appraisal. Number one, the exchange rate estimations, and this is the first thing. Number one, by purchasing power parity theory, or number two, that is interest rate parity theory. If you wanted to estimate with respect to the purchasing power parity theory, estimated spot is equal to spot now. It's some typing mistake. Something like this. Estimated spot rate is equal to spot rate now, and then multiply with 1 plus inflation A, 1 plus inflation B. Or interest rate parity theory, that is estimated spot rate is equal to spot rate now multiply spot rate now multiply 1 plus interest A, 1 plus interest B. So I know that there is a confusion that what is the meaning of inflation A and inflation B? Candidates, it depends that how exchange rates data is given. For example, exchange rate, in my example, exchange rate given in term of Australian dollar versus UK. Australian dollars over UK. Australian dollars over UK. So Australian dollars over UK means Australian dollars is numerator. So inflation given. So inflation of Australia is numerator over UK. UK based denominator, that's inflation of UK is denominator. That is the point. Same case interest. How examiner will examine either purchasing power or interest rate? It depends on the question. It depends on the question. If the data is given with respect to the inflation, then we will use the inflation aspect. If the data is given with respect to the interest, we will use the interest. Like this. A very basic question. A very basic question. For example, this is a question. Exchange rate estimations. Question 1. The spot exchange rate is euro 1.5325 to sterling 1. That is 1.5325 per sterling. Means euro is numerator and sterling is denominator. Sterling is denominator. Spot rate is, we can say that this is now. The rate is now. Spot means now. Expected inflation rates, that is year 1 inflation rates 3% Europe, 1% UK. Next year, this is estimations. Second year, 1% Europe, 4% UK. 3%, 2%, 3%. Use the relationship above. But what are the relationship above? The relationship is inflation. The relationship inflation to work out the expected spot rate for the next 3 years. So candidates, we can work out accordingly. Now the spot rate is given based on euro over sterling, and that is 1.5325. Year 1 inflation, this is the formula. Definitely if the data is given inflation, then we will use purchasing power parity theory. If the data related to interest, then interest rate parity theory. Here the case of the inflation, that the relationship of the inflation, the term inflation, then we can use. Now how it works? Inflation in Europe year 1, that is 3%, data is given, and that is 1%. And how it works? 1.5325 multiplied by 1 plus inflation. 1 plus 3% divided by 1 plus 1%. And you can calculate accordingly. It's very, very simple, candidates. It's very, very simple. 1.5325 into 1.03 divided by 1.01, that is 1.5628. Then 1.5628 multiplied by next year. How to determine what is numerator, what is denominator? It depends. It depends how the data is given. Euro numerator, this is denominator. So we decide euro sterling. Euro inflation, sterling inflation. Accordingly. That 1.01 . 1 plus 4%, and that's given 1% and 4%. Even though 1.5628 multiplied by 1.01 divided by 1.04, that is 1.5177. Then 1.5177, that is given 2% and 3%. And that is 1.5030. It's very simple, candidates. It's very, very simple. So first thing is what we have to know, the working about how to estimate the exchange rate. How to estimate the exchange rates. This is the first most important thing. This is first most important thing for the foreign exchange. Sorry, for international investment appraisal. Number one. Now, candidates, once again, visualize that how we will work. As I mentioned here, that the basic working here. Estimate the cash flows in foreign currency and convert into the local currency. That is number two. First we have done. Now we have to do a basic working about just pick up the cash flows in the foreign currency and using the estimated exchange rates and then convert into the local currency. Now once again, there is another question. This one is the question, and this question is already given on the handout. You can get it. You can read from the handout as well. Read the question once. You have 15 seconds. Read the question once. Please read the question once. Please read the question once.